Last week, McDermott brought an exclusive interview discussing a recent bond rally as Ireland set its sight on a return to the market. Portugal continued the trend at the end of the week, and after 6 years of stagnation, Greece may mark the midpoint of 2014 with a summer sell-off. Joining me down the line to discuss this increase in bond appetite is Hampden Turner. Michael, such is the confidence in Europe that Greece, which sparked Europe's sovereign woes in 2009 and required 2 bailouts, said it may sell 5-year notes in the second half of the year. The step would mark Greece's return to bond markets since being shut out in early 2010, following alarm about the size of its budget deficit. Do you believe this is really on the cards for Greece?
Well, it certainly is the stated ambition of the Greek political establishment. They're looking to achieve about $3 billion in bond issuance this year, almost certainly through private placement. Even so, it would be an impressive milestone after only 2 years after their default. And obviously it follows hot on the heels of improvements in Ireland and Portugal, where demand for bonds has been pretty strong, who are now looking to set up more regular auctions. So on the one hand, it seems like a bit of a stretch fundamentally, but on the other hand, risk appetite among investors is very strong. Demand for Portugal and Irish bonds has been very strong, for example.
The rally's roots can be traced to July 26, 2012, when Draghi pledged to do whatever it takes to protect the region from the unfolding debt crisis. So far, the policy line remains little changed, with interest rates at record lows and speculation of negative rates being adopted if or when needed. Just how integral is the ECB backstop to sentiment towards debt-stricken peripheral countries such as Greece, such as Portugal, as you mentioned?
The position of central banks has been pretty critical to improving sentiment towards peripheral countries. For example, major domestic political upheavals, as we witnessed in Italy in the second half of last year, really barely registered on in the sort of B2B market. Bond yields remain consistently tight, and investors are much more focused on what the Fed is up to and what the ECB has been up to, rather than, say, Berlusconi. With conditions good, I think that backstop remains pretty solid, and I guess the question is whether the backstop looks as firm when there's more stress in the market. But for now, markets seem pretty convinced.
The performance of Greek bonds this year reflects a combination of political risk and economic achievement. But how real is the risk that an apparent slackness on completing reforms may cause investors to run scared once again?
Well, I guess the risk, the backstop that we just talked about, is that a failure to complete reforms saps the willingness of the Troika to continue to fund Greece. Greece remains heavily reliant on external financing. The fact that this bond issue, for instance, is designed to cover an expected shortfall between the official financing, which is going to be about $17.5 billion this year, and Greece's actual sort of requirements, that's not going to improve the Troika's view. Having said this, the focus at the ECB is so much more on growth now that they don't like talking about cuts and so on, and really they are interested in putting the crisis and any question of any people questioning European solidarity. They want to put all those things behind them. So the risk of losing the gains to date seem much greater than the political risk of not being tough on bailout conditions. I think for now they find a compromise.
The resilience of the single currency is something which hindered struggling countries over the course of 2013. With the divergence in policy between the ECB and Federal Reserve expected to become yet more prominent, how do you see the euro-dollar performing over the coming months?
At Citi, we think the euro continues to be supported by flows from a burgeoning broad balance of payment surplus, which is made up of both capital inflows, for instance, especially to equities as investors look at recovery plays, but also a strong and rising current account surplus. So things look relatively strong. We still expect to see the euro at least 140 plus this year. More broadly, although there's a lot of anticipation about the potential for early rate hikes in the US, or even if the rate hikes don't come early, perhaps they're much more sudden or much steeper at the end of the forward guidance period. But we don't necessarily think this translates into dollar strength. So, for instance, if we look at historical dollar performance around rate hikes in previous cycles, this tends to confirm our view. You don't always have dollar strength following this pattern.
Michael, thank you so much for your time and insights. Well, that's all from me for the moment, but click back to DukascopyTv for today's press review with McDermott on the controversy affecting Bangkok. Goodbye for now.